All right, guys, welcome back to the LPR Trading Group YouTube channel here. I got another video for you today. Now, I'm in a bit of a different setting here. I do have the camera on. I'm outside of my backyard. There's a pond going. I've got chickens running around. It is what it is. This is where I wanted to film today. What we're going to talk about is the perfect trading plan. Now, this isn't about, what's the holy grail trading strategy, this, that, and the other thing. It's how to set yourself up to execute a perfect trading plan. Now, a lot of traders and most traders are worried about the results, and they forget about the process. The thing is, it's the process that gets you to those results, okay? So this is what I'm going to go through. I'm going to talk about a few things that we talk about within our group as well to give you guys some ideas on how to build out your perfect trading plan. So let's get through these slides right here. There's about 4 or 5 slides. And at the end, I'll give a few examples here for you. So what we're going to talk about is number 1, the market lawyer mindset. Number 2 is going to be trending markets. We have to identify what market we're in order to execute our trading plan properly. There's going to be a trading plan for a ranging market, a sell-off, a run-up phase, recognizing whether we're in accumulation or distribution. So you have to be able to recognize these markets. So we're going to talk a little bit about trending markets, ranging markets, and how to execute day after day based on the plan that you put together. So first is the market lawyer mindset. We have to identify the current market conditions. This is essential when building and executing your trading plan. Knowing what market condition you are in will keep you off of the mouse and keyboard when the odds are less favorable to your trading style. What most people don't understand is cash is actually a position in the market. You don't constantly have to be in a position in order to make money. There's market conditions that are more conducive and more favorable to your specific trading style than other markets. So if you trade well in one market and not so well in the other, it is your job as a trader to recognize what markets you are trading well in and avoid the markets that you are not trading well in. This seems so simple, but for some reason, people just want to dive into the market every single day, load the gun, and just start firing out of nowhere when things are just simply not meeting their plans and criterias. So what do I need to see in order to click the button? Like I said, you need to see certain things. You need to have this market lawyer mindset in order to execute proper trades and be a profitable trader within the market. Many traders have rules, but the rules are too loose. Example, when I see a green bar, I buy the high break of the green bar. What does this even mean? It might seem silly to some of you, but trust me, I've been through a lot of groups. I've talked to a lot of people, and this is how some traders trade. It's absolutely ridiculous. They don't see any of the market context. They don't know what markets they're trading, what the markets are doing. They're just simply buy the high break of the green bar. It's absolute nonsense, okay? Instead, we need to do things as follows. So market lawyer mindset again. What actions create the perfect trade for me? Okay, so what do I need to see in order to execute on the perfect trade? Also, what are my minimum requirements? What are the minimum pieces of evidence I need in order to click the button? So if we're a lawyer going into a court case and, we just tell the judge, yeah, my client's innocent because he wasn't there. Well, the judge isn't going to buy it, right? You're essentially not a good lawyer. But if you go in with multiple pieces of a puzzle and give this judge multiple pieces of evidence, now you have the judge and the jury scratching their heads saying, wow, this is a lot of evidence saying that this client is guilty or this person is innocent, whatever it is. This is the same as trading. If you're looking at a trade and there's only one little thing that tells you this trade might work, this might be the one, it's probably not the trade, okay? If you were looking for 6 pieces of evidence, for example, you might be satisfied if you see 4 out of 6. I'm not saying you have to have every single piece line up all the time, but you need the majority. That's just how it is. The more you have, the better the trade. If you have more pieces of evidence, that likely means more people are seeing what you're seeing. Now, people think trading is a big secret. The less people that know, the better off it's going to work. Okay, it could be exploited by the bigger money if too many people know. If your strategy and your system is very meticulous and very systematic and it's easy to break. But for the most part, the more people that see the trade, the more money is going to be on board in the direction that you want to trade it. So the trade's more likely to work. If you have less pieces of your puzzle, but you think there's more development to be had in the market, maybe you can start a smaller position, a quarter size, a third size, a half size, until the trade really starts playing itself out, and then you add more. I always tell the group, if you see a setup and in your head you say, okay, this isn't a great setup, maybe it's a C setup, there's 20% chance this is going to work, put on 20% of your position. Don't just load the boat when the trade's like, it might or might not work, okay? Nothing's guaranteed, but there are high probability situations and scenarios. So, as I said, I covered this at the bottom right here. Lawyers never or very rarely win a case with a single piece of evidence. It's simply not enough to prove someone's guilt or innocent. Multiple pieces of evidence are what separate the bad lawyers from the great lawyers. Exactly the same with traders. If you're losing money in the market, you can simply go back and look at your trading and say, why did I take this trade? Most of the trades you took are likely going to be some nonsense reasons that make no sense, that were just on a whim or out of FOMO, or he took it so I took it, or it started running and I just jumped on the bandwagon. These are nonsense reasons to take a trade, okay? So move on to the next slide here. So a trending day in the market. How do we establish what to do on a trending day versus a ranging day versus different market context days in the market? So what is your setup when the market or market day is trending? We must be very specific here. Not all trade types work in all market conditions. I see people trading a range-bound market as if they were trend trading it. Then by the time they recognize the market's ranging, which is days, weeks, or even months, they say, oh, the market's ranging. Well, now I'm going to change some stuff up and do some crazy stuff, and then it goes back to trending. You have to be able to recognize what market condition you're in. One major problem I've seen across the years is when traders mindlessly trade the same strategy, just like I said, day after day after day, and completely disregard current market conditions or market context. Now, this usually happens to the traders that have a very successful 2 months, and then they fall off the boat for 2 or 3 months and possibly blow up, and it's an absolute disaster, and then they change their strategies and all that jazz. It's just because you're not recognizing the market you're trading in. The way I look at this is, if you show up to a baseball diamond with a hockey stick, you're not going to do very good at the sport. You walk into the baseball diamond, you recognize it's a baseball diamond, you have to get a glove and a bat in order to perform this sport. Okay, it would not work if you came in with a hockey stick. Too many traders are coming to the markets with a hockey stick. It's not going to work. The only time it works is when you accidentally walk into the hockey arena with your lucky hockey stick, and now you can play the game. The way we combat this is we build out a system, which we have at LPR within our group, to get into trades at best price in the direction of the current trend. So we have a market that's running up or running down. We've recognized it's trending. This is what we're looking for on a trending day in order to get an entry into this move. We don't have to catch the bottom. We don't have to catch the top. We just have to look for the meat of the move. By identifying where the market can possibly move to or where it could go gives us an idea of the upside or downside we have for the remainder of the session. This gives us the opportunity to take high probability trades with the current market trend. What I see too many people doing is market's moving up and it's gone up 20 points and they're just trying to reverse the market, short, and they're just getting run over. And the market's running to the upside. They're just too one-sided. They can't admit they're wrong. They can't recognize they're in a trending day, and they just get run over. And these are the days where traders blow their accounts up. And it's horrible. I've done it before years ago. It's horrible. It's not the way to trade. When building out this system, you need to have strict rules, as always. Like I said before, some traders' rules are not strict enough. I'm going to buy the high break of the green candle. That makes no sense. Those aren't rules. Number one, where are the areas you are looking to enter? This is what I do. As the market's playing itself out, I identify areas I'm looking to enter, long or short, and I wait for the market to come into those areas. When and only when the market comes into those areas is when I start exercising the next pieces of the puzzle. And this is where I really start breaking the trade down, trying to find an entry if it gives me one. This doesn't mean that every single time it comes back into my range or my area that I want to play the stock or the market. It doesn't mean I'm getting into it every time. This is when I start exercising the plan and moving on to phase 2. Okay. What signs and signals are you getting to confirm your thesis? So you have a thesis, you have an idea. What are the signs and signals you're getting to confirm this? What will you do when your evidence starts rolling in? You're going to start getting pieces of the puzzle thrown at you. Pieces of evidence are going to start rolling in, and you have to execute on them. The only way you can properly execute on these is knowing what you're going to do when they show up. Sometimes the market gives you a lot of time to get in. Other times it flashes you a signal and it goes away. So you've got to be able to execute when the market's giving you signals. Pullback trades in the direction of the current trend is what we use in LPR to navigate these days, trending days. We look for high emotional areas where we can find retail participants offside and where large money is looking to start a position, and we ride that wave. So we're not just buying high breaks. We're not just buying nonsense that retail's buying. We're waiting for these emotional moments in the market, these emotional pullbacks in the market where we can see that retail's put themselves offside. The bad retail shorts are shorting too early. They're going to get run over. They're just providing liquidity for bigger money, and we're getting in with the bigger money. Retail's bad. We are retail. So if we want to trade like bad retail, we continue trading that way. The only way to trade, in my opinion, is think like bad retail, trade like big money. This is what we do here, okay? On to the next slide. So ranging markets. This is a different type of market. This is a market that's just chopping sideways in a range for a day, a few hours, a few weeks, whatever it is. How do we trade these markets? Ranging markets are much different than trending days. We're typically not holding trades as long for obvious reasons. We're ranging. We're not trending and moving higher or trending and moving lower. Trading highs and lows of a given range can be very profitable. Short the highs, buy the lows. I know I make it sound easy, but most of the time in a ranging market, it truly is that easy. Short the highs, buy the lows until the market proves otherwise. Now, this is not the only piece of the puzzle you look for. There's other criteria we look for in doing this, but this is the general idea. A huge mistake I see in most traders is they get into a range day trade, but they get very greedy. Maybe they bought the low. Now they're looking for it to, instead of taking profit at the high, they're looking for it to break the high. They don't sell their position and take profit as they should have. The trade fails, it comes back, it stops them out break even, or maybe even with a loser, okay? Ranging markets or range days equal faster trades. Less chance you'll find a big runner, but it's going to give you a very easy range to trade. Typically on a ranging day, you can have more trades because there's more opportunity, the ranges are smaller, and it tests those areas more often. Whereas trending days, it'll give you maybe one or two entries to hit the trend, and if you don't hit the trend, the trade's gone, which is fine. But Dave, listen, what if I get in a range trade, or what if I get out of the range trade and it runs without me? So I've heard this from a lot of people too. Look at my entry, Dave, right at the lows. I got it at the highs and it ran another 60 points. It is what it is. You're never going to catch the bottom. You're never going to catch the top. This is literally a unicorn trade. I want you to show me one person who's got into a trade at the bottom of a trend, bottom tick the trend, and got out and top tick the trend. Okay? This is very rare, extremely rare, and it is not repetitive. You cannot repeat this consistently. Okay? The longer you chase this unicorn trade, the longer you're going to fail. It's just plain and simple. The way I look at trading is like this. When you're fishing, typically, for those of you that eat fish, you're fishing, you catch the fish, you fillet the fish, so you take the body, you leave the tail, and you leave the head. This is like trading. When we're trading, we enter a trade and we're looking to get the body of the trade, maybe 50 to 60% of the move on 50 to 60% of our position. And this is considered a good trade, a really good trade, actually. So one specific trading range break, we could go from a ranging day to a trending day. It is important we recognize. So it's important we recognize if we go from a ranging day to a trending day or a trending day to a ranging day. Okay? We recognize this and we adapt our strategies and mindset. This might mean switching your mindset from being short bias to long bias. A lot of traders have problems switching gears, especially midday or mid-trade, and they begin to catch falling knives or shorting larger runners because they simply can't admit their thesis may have been incorrect. Learn how to switch gears. For example, you're in what you think is a ranging day. Stock is ranging, you shorted the highs. Okay? It pulled back. You didn't get your partial. It broke the highs. You tried to short it again. It pulled back a bit, broke the highs again. You tried to short it again. We're not in a ranging day anymore. We've broken the range. We're now trending. The problem is most traders have tried it short once, twice, maybe made money, maybe lost money, and now they just want to keep going at this short. Well, it doesn't work that way. The market has proven it's coming out of the range and we're now trending. We do not get in front of the freight train and try and hard reverse these things, especially when they come out of a consolidation range. That builds power and strength in a given direction. If you want to get run over, you get in front of these things. I don't want to get run over. I will absolutely change gears and just go with the trend if there's an entry. Hop to the next slide here. So now we execute day after day. So we take all of the notes that you've made on your trading system. And remember, each execution or each strategy you have has to have very specific criteria. Okay, very specific criteria. The system could be perfect on paper, but if it's littered with user error, it will feel like a disaster. I've given my exact trading plan to another person, and they've completely butchered the whole thing. Why? Not because the plan didn't work, because I reviewed all their trades. It was, oh, Dave, I got into this, but I was in this market. I just thought it might have worked. Oh, Dave, I didn't let this run. I know I should have let it run because I was in a trending market, but I didn't want to give my gains back. Okay, this is user error. You have not followed the plan. I've made a plan for a ranging day, a trending day, and any days I don't see something fall into part of my plan, we don't trade. What doesn't follow into my plan? A trending day that doesn't give me an entry. If I don't get an entry in the market in the first hour and a half, I'm probably not trading that day. I've completely missed the trend, not missed it. It's just gone without me and not giving me an entry, which is fine. I just stay cash and move on to the next day. Okay? Realize this, you're not going to win every trade. There'll be trades where you have 6 out of 7 pieces of evidence and you lose. Inversely, there'll be trades that you have 1 piece of evidence and you win. Winning and losing in trading, it's not about, what worked and what didn't, or being red and green or blah, blah, blah. It's just about, did you execute your plan? When you go back to that piece of paper at the end of the day, can you be honest with yourself and say, yes, check, I executed my plan. I was red, pat on the back, I did well today. This is how you have to judge your progress. Years ago, I would have a horrible day on the charts, but I'd be green $2,000 and I'd be happy. Yeah. So no, it's not like that anymore. If I trade like an absolute donkey and I have a green day, I'm not thrilled. I'm not thrilled at all because I've accidentally broken rules. I've done something I shouldn't have. Whatever the case may be, I'm just not happy. If I have a red day and I lose $500 or $1,000, but I've done everything exactly as we planned, I know that this is the right thing to do, and I'm absolutely thrilled with that. The money is just a byproduct of you executing this plan and process day after day after day after day. And listen, it sounds boring because it is. If you want excitement, trading is not the game for you. If you're trading and you're anything but a scalper and this is super exciting and you get this crazy adrenaline rush and your blood's pumping all day, you're losing money. I guarantee you. If you want a thrill, you got to go jump out of a plane, not sit down on the charts and trade. The best traders in the industry are bored to tears because they're just waiting and waiting and waiting. And when the opportunity finally comes, they just know, I just got to click the button, put the stop in, put the targets, and just wait. Waiting. It's up to you. Okay, it's totally up to you. If you find certain days easier for you to trade, you must adapt to those conditions. Recognize what days you're trading well. Trending market, ranging market, a sell-off, a rally, whatever it is. Only expose yourself to market risk when you're presented with high probability situations that suit your trading style. Okay? It's plain and simple. If you can find days that are going to suit your trading style, this is ideal. This is what you need. Okay, now some examples of our trading plan. I sort of went through them. Things that we would look for. I would look for at least 5 pieces of evidence to take a trade. Okay, the evidence could be I need to recognize we're in a trending market. By a trending market, maybe it's if we've broken the high of the 15-minute initial balance. So we've broken the high of the 15-minute initial balance. This is my first key that we might be in a trending market to the upside today. Any pullbacks that I see, I want to see them on low volume, and I want to see the pullbacks when they get bought up on higher volume. If you use any sort of market internals, like volume market internals, maybe you're looking for a divergence between volume and price. Price is moving down, volume behind the scenes is moving up, especially for the long side, at market to the offer. This is giving you an idea that these pullbacks are getting bought up. Is my risk reward acceptable on the trade, et cetera, et cetera. So these are some examples of pieces pieces of the puzzle you would have, evidence as a market lawyer. Now, here's some trading plans right here that I have written out. I'm going to leave this here for you guys. You can pause it, read through it if you have any questions. I want to hear everything down in the comment section, and we can have a chit chat about this. But these are just some examples. Some of it is, what we do in the group, but this is really what you want to be doing right here. And I want you guys to go through this for yourselves on trending days right here to see if you're looking at some of these things when you're looking to trade a trending day. Or maybe what you're looking at is totally different, which is fine, but it works for you, okay? And with that, we'll end it here. Thanks a lot, guys. Remember, we're market lawyers. Build your case, put all the pieces of the puzzle together before you risk your hard-earned money on a trade. It's just that simple. If you have any questions, hit me up down below, like, comment, subscribe. And if you guys are interested in access to our Discord channel, I'm probably going to be sending out a week or two free invite in the next probably week or two. So stay tuned, guys. Make sure to like, comment, subscribe. Thanks.